There is a silent, perfectly legal mechanism buried deep within the United States tax code that specifically targets you during a single, highly vulnerable year of your life. It is a system most people have never heard of, operated jointly by the Internal Revenue Service and the Social Security Administration, and it is designed with a terrifying level of precision. When we think about retirement, we are conditioned to obsess over specific milestone ages. We mark our calendars for age 59 and a half, knowing that is the magical moment we can finally access our retirement accounts without being hit by early withdrawal penalties. We look toward age 62 as the earliest possible starting line for claiming Social Security benefits. We anticipate age 65 as the golden threshold for Medicare eligibility, and we dread age 73 because that is when the government forces us to take required minimum distributions. But no one tells you about age 63. Age 63 is treated differently from every other age in retirement. It is the quiet mistake that destroys people. Financial advisors rarely flag it. The government is legally forbidden from offering unsolicited preemptive advice about it, and millions of well-meaning, hardworking Americans step on this financial landmine every single year. You see, the system is built to work quietly against you. It thrives on your lack of information. By the time you find out what happened at age 63, you will be 65 years old, and it will be too late to undo the damage. The trap will have already snapped shut, locking you into a devastating financial penalty that strips thousands of dollars away from your fixed income, draining the exact accounts you spent 40 years sacrificing to build. To understand how you are being hunted by this obscure bureaucratic regulation, you first have to understand how the institutions view your retirement timeline. To you, retirement is a continuous journey. You stop working, you start drawing down your assets, and you try to enjoy the time you have left. But to the federal government, retirement is a series of strictly compartmentalized data points. The IRS and the Social Security Administration do not look at your life as a cohesive story. They look at snapshots of your financial data, and they use those snapshots to predict your wealth and assess your obligations. Here's the terrifying truth about the age of 63. Your 63rd year on this earth serves as the ultimate diagnostic test for the rest of your healthcare costs in retirement. It is the anchor year. It is the year of the grand audit. Everything you do financially between the day you turn 63 and the day before you turn 64 is permanently etched into a federal database, sealed, and shipped off to determine exactly how much you will be punished 2 years later. Let us look at a completely innocent, incredibly common scenario. Imagine you have just turned 63. You have decided to officially retire. You sit down at your kitchen table, look at your finances, and you make a deeply responsible, traditionally conservative financial decision. You decide that you want to enter your Medicare years completely debt-free. So, you log into your retirement portal and you pull a lump sum out of your traditional individual retirement account or your 401k to completely pay off the remaining balance on your mortgage. Or perhaps you decide to sell some long-held mutual funds in a brokerage account to buy an RV, or to finally take that massive trip you and your spouse have been talking about for decades. In your mind, you are simply enjoying the money you saved. You pay your standard income taxes on that withdrawal, you celebrate your newfound freedom, and you move on with your life. You think you did everything right, but you just triggered a catastrophic cascade of events. What the system deliberately does not warn you about is the Medicare 2-year look-back provision. This was quietly birthed from the Medicare Modernization Act of 2003, a piece of legislation drafted in labyrinthine legal language that permanently altered the landscape of retirement healthcare. Under this law, the government decided that wealthy retirees should pay significantly more for their Medicare Part B and Part D premiums. But they had a logistical problem. How does the government know if you are wealthy when you first apply for Medicare at age 65? They cannot use your tax return from age 65 because you have not filed it yet. They cannot use your tax return from age 64 because the IRS is still processing those returns during the open enrollment period. So, by sheer bureaucratic necessity, the Social Security Administration reaches back exactly 2 years in time. They pull your tax return from the year you were 63. This means the financial decisions you made at 63 dictate your baseline healthcare costs at 65. That lump sum you pulled out of your IRA to pay off your mortgage, that caused your modified adjusted gross income, or MAGI, to spike. The IRS reported that spike to the Social Security Administration. The algorithms in the federal database flagged your file, and now, exactly 24 months later, you go to your mailbox to find an incredibly confusing, sterile-looking envelope from the government. Inside is a notice informing you that because of your high income, you are now subject to something called IRMAA. IRMAA stands for the Income-Related Monthly Adjustment Amount. It sounds like a mild administrative fee. It is not. It is a punitive, ruthless wealth tax disguised as a healthcare premium surcharge. When you are hit with IRMAA, your Medicare Part B and Part D premiums do not just go up a few dollars. They can double, triple, or even quadruple. Suddenly, instead of paying the standard base premium of roughly $174 a month, you are being billed $500 or $600 a month per person. If you are married, that surcharge applies to both of you. You are suddenly bleeding $10,000 to $12,000 a year out of your retirement accounts just to maintain the exact same basic medical coverage that your neighbor is getting for a fraction of the cost. And the most insidious part is how they collect this money. They do not send you a bill that you can dispute or negotiate. They simply intercept your Social Security check and siphon the funds out automatically before the money ever hits your bank account. You log into your bank expecting your hard-earned Social Security deposit, and a massive chunk of it is just gone, evaporated into the bureaucratic ether. The cruelty of IRMAA is deeply embedded in its mathematical structure. In the United States tax code, most taxes are progressive. If you earn $1 over a certain tax bracket, only that single extra dollar is taxed at the higher rate. But IRMAA does not use a progressive bracket. IRMAA is a cliff penalty. This is a vital distinction that financial institutions purposely gloss over. The government sets specific income thresholds for the IRMAA surcharges. If your modified adjusted gross income at age 63 lands exactly on the threshold limit, you pay the base premium. But if your income goes over that threshold by a single dollar, just one single dollar, you fall completely off the cliff into the next penalty tier. You do not pay a percentage on that $1. That single dollar triggers the entire multi-thousand-dollar surcharge for the entire year. Imagine selling a single extra share of stock to take your grandchildren out to dinner, pushing your income $1 over the limit at age 63, and as a direct result, the government confiscates thousands of dollars from your Social Security checks 2 years later. It is a disproportionate, unforgiving, and deeply hidden trap. Let us dig deeper into the real estate trap at age 63, because this is where the quiet slaughter of middle-class wealth truly happens. Millions of Americans approach their early 60s with a significant amount of equity tied up in their primary residence. The kids have moved out, the house feels too big, the stairs are becoming a nuisance, and property taxes are climbing. The logical, universally accepted financial wisdom is to downsize. So at age 63, you put the family home on the market. You sell it, maybe generating $500,000 or more in profit. The current tax law allows a married couple to exclude up to $500,000 of capital gains on the sale of a primary residence. You think you are completely safe because the sale is technically tax-free under the Section 121 exclusion. But here is the devastating technicality that the system uses against you. While that profit might be exempt from standard income tax, any profit over that exclusion amount, or any depreciation recapture if you ever use part of the home for business, violently impacts your gross income. Furthermore, many people who downsize do not just sell a primary residence, they sell a secondary property, a vacation cabin, or a piece of inherited land. All of those capital gains are forcefully injected into your modified adjusted gross income during your 63rd year. You take the cash from the real estate sale, buy a modest condo in a warmer climate, and put the rest in the bank to supplement your fixed income. You feel secure. You feel like you have successfully navigated the transition into retirement. Then you turn 65. The Social Security Administration looks exactly 2 years backward, sees the massive influx of capital gains from the property sale, and categorizes you as a high-income, ultra-wealthy retiree. It does not matter to the government that this was a once-in-a-lifetime asset liquidation. It does not matter that you are currently living on a fixed income of $3,000 a month. The computer algorithm only sees the snapshot from age 63. You are slammed with the maximum possible IRMAA penalty. Your Medicare premiums skyrocket. The money you carefully extracted from your home equity to pay for your groceries and utility bills is now being systematically drained by the federal government just to cover your basic health insurance surcharges. The security you thought you purchased by downsizing was an illusion. But there is a scenario that is even darker, and it revolves around a horrific flaw in the tax code known as the widow's penalty. This is an intersection of grief and bureaucracy that is entirely devoid of empathy. Imagine a married couple. They have spent their entire lives planning their retirement together. They have carefully calibrated their combined pensions, Social Security expectations, and withdrawal rates. Then, tragically, one spouse passes away when the surviving spouse is 63 years old. The surviving spouse is devastated, plunged into mourning, and suddenly forced to navigate a maze of funeral expenses, account transfers, and estate consolidation. Often, the survivor will receive a life insurance payout, or they will need to liquidate an investment account to cover sudden medical debts or end-of-life care costs incurred by their late partner. At the end of the year, the surviving spouse files their taxes. Because their partner passed away during the year, they can still file as married filing jointly for that specific tax year. But the very next year, their filing status drops to single. Here is where the trap brutally closes. The IRS thresholds for the IRMAA penalty for a single filer are roughly half the thresholds for a married couple. When the surviving spouse turns 65, the Social Security Administration looks back 2 years to when they were 63. They see the income spike from the life insurance dividends, the liquidated accounts, or the final burst of earning from the deceased spouse. But instead of measuring that income against the generous threshold of a married couple, the government measures it against the severely compressed threshold of a single widow or widower. The surviving spouse, who is now living on only one Social Security check instead of two, who has already lost a massive portion of their household income, is suddenly categorized as a wealthy individual by the automated system. Because of the compressed tax brackets and the lowered penalty thresholds, the widow is hit with a massive Medicare premium surcharge. The government effectively penalizes them for the death of their spouse by confiscating a larger percentage of their sole remaining income stream. They are left alone, financially suffocated by a completely blind, unfeeling calculation that took place while they were at the lowest emotional point of their life. This happens in the shadows, every single day, to families who thought they had prepared for everything. Then we have the trap of well-intentioned financial advice. If you spend any time reading financial blogs, watching retirement seminars, or listening to wealth managers, you will be bombarded with the concept of the Roth conversion. The logic is aggressively pushed upon the public. Take money out of your traditional pre-tax IRA, pay the taxes on it now, and move it into a Roth IRA where it can grow tax-free forever. It sounds like a brilliant strategy to starve the IRS of future tax revenue. Advisors champion this as the ultimate defensive move against rising future tax rates. So, you listen to the experts. At age 63, you decide to execute a massive Roth conversion, shifting $100,000 from your traditional account to a Roth account. What the financial advisor conveniently forgets to mention, or perhaps does not even know because they are entirely focused on tax efficiency rather than healthcare premiums, is that a Roth conversion is treated as ordinary, taxable income in the year you execute it. By executing that conversion at age 63, you artificially inflate your modified adjusted gross income to towering heights. The IRS records the conversion. The 2-year clock begins ticking. You reach age 65, ready to enjoy your tax-free Roth growth, only to receive the dreaded envelope from the Social Security Administration. Your massive Roth conversion at 63 triggered the highest tier of the IRMAA penalty. The thousands of dollars you thought you were saving in future taxes are instantly wiped out by the thousands of dollars you are now forced to pay in mandatory Medicare surcharges. You executed a complex financial maneuver to protect yourself, and instead, you walk straight into the government's crosshairs. You weaponized your own wealth against yourself simply because you chose the wrong year to make the move. The sheer scale of this problem is staggering. We are talking about millions of retirees being quietly stripped of their financial dignity because they do not understand the invisible architecture of age 63. You are told to plan for inflation. You are told to plan for market volatility, and you are told to plan for long-term care. But you are never told to plan for the fact that the government uses a 2-year delayed explosive device to penalize your income. And the psychological toll of this is profound. When you work your entire life paying into a system under the promise that the system will provide a baseline level of support in your final years, discovering that the system has engineered a loophole to claw that money back feels like a deep personal betrayal. It induces a terrifying sense of helplessness. You realize that your savings are not entirely your own. They are subject to invisible tripwires, and if you step an inch out of line, the financial consequences are swift and non-negotiable. By now, you are likely feeling a rising sense of panic, especially if you are approaching this critical age or if you are currently in it. You are wondering how it is possible that something so destructive is entirely legal and completely unadvertised. You are calculating the moves you made last year, trying to remember if you sold any stock or moved any money that might trigger this bureaucratic assassination of your fixed income. The anxiety is entirely justified because the system relies heavily on your ignorance. The system wins when you simply accept the letters in the mail and allow them to quietly deduct the surcharges from your accounts. But here is where we turn the tables. Here is where the information asymmetry ends. While the institutions have built a massive, intimidating apparatus to extract this money from you, they have also, out of legal necessity, left a backdoor open, a deeply buried escape hatch. The solution to the age 63 trap is disproportionately simple compared to the complexity of the problem, but it requires you to be aggressive, proactive, and incredibly specific. First, we must address the preventative strike. If you have not yet turned 63, your objective is complete and absolute income suppression during that single 12-month window. You must treat age 63 as a financial quarantine zone. If you need to pay off your mortgage, you pull the money from your IRA at age 62, or you wait until age 64. If you need to execute a Roth conversion to protect your assets from future taxes, you complete those conversions before your 63rd birthday, or you carefully stagger them in tiny increments later in life. If you are planning to sell a business, a massive piece of real estate, or liquidate a heavy stock position, you orchestrate the timeline so that the transaction closes in any year other than the year you turn 63. You artificially lower your modified adjusted gross income for that exact snapshot period. You live off cash reserves, you draw from already taxed accounts, and you starve the IRS of any data that makes you look wealthy. You simply remove yourself from the crosshairs before the algorithm takes the picture. But what if you are already past this point? What if you are 64 or 65 and you realize with a sinking feeling in your stomach that you made the fatal mistake at 63? What if the envelope from the Social Security Administration has already arrived and they are demanding a massive surcharge? This is where you deploy the ultimate defensive weapon. It is a specific, heavily guarded document known as Form SSA 44. The government does not want you to know about Form SSA 44. They do not advertise it, they do not include it in your welcome packets, and they certainly do not make it easy to find unless you know exactly what to search for. Form SSA 44 is the Medicare Income-Related Monthly Adjustment Amount Life-Changing Event Form. It is your formal declaration of war against the algorithmic snapshot. The premise of Form SSA 44 is brilliant in its simplicity. You are legally telling the government that the snapshot they took of your finances at age 63 is a lie. You are informing them that a specific, legally recognized, life-changing event has occurred since that tax return was filed, and that your current income is drastically lower than the inflated numbers from 2 years ago. The form lists a very strict set of permissible life-changing events. You cannot just say you spent the money or that you disagree with the tax. You must select one of the sanctioned checkboxes. The most powerful and universally applicable checkbox on this form is work stoppage or work reduction. Think about how beautifully logical this is. At age 63, you were likely still working, or you retired mid-year and took a massive severance package or a retirement account payout. Your income was high. At age 65, you are fully retired. You have legally stopped working. By checking the work stoppage box on Form SSA 44, you force the Social Security Administration to throw away the tax return from age 63. You force them to bypass the 2-year look-back period and instead calculate your Medicare premiums based on your projected income for the current year. You are demanding that they judge you on your reality today, not your artificially inflated past. If you suffered the widow's penalty, there is a specific checkbox for the death of a spouse. You check that box, provide the death certificate, and the government is legally obligated to immediately recalculate your premiums without the compressed, punitive, single-filer thresholds based on your combined past income. If you went through a divorce, there is a checkbox for marriage annulment or divorce. If your pension collapsed, there is a checkbox for loss of pension income. Filling out Form SSA 44 takes approximately 10 minutes. You download the PDF, you check the appropriate life-changing event box, you write down an estimate of what your actual income will be for the current year, you attach a single piece of evidence, like a retirement letter from your former employer or a copy of your severance agreement, and you mail it directly to your local Social Security office. That 10-minute move, that single piece of paper, can instantly reverse the entire IRMAA penalty. It can force the government to refund surcharges they have already extracted from you, and it permanently resets your premium baseline, saving you thousands of dollars a year for the rest of your life. It is the silver bullet to the age 63 trap, hidden in plain sight inside the bureaucratic labyrinth. But we have to talk about why this matters on a human level. The financial mechanics are cold and calculating, but the reality of how this plays out in our lives is deeply emotional. One of the most heartbreaking aspects of the age 63 trap is how often it is triggered by an act of profound love. As parents, as human beings, our deepest instinct is to provide for the people we care about. We want to be the safety net. So what happens at age 63? Your daughter gets engaged and you decide you want to pay for her dream wedding. You pull $50,000 out of your traditional IRA to cover the venue and the caterer. Or your son wants to start a business and you liquidate a chunk of your stock portfolio to give him the seed capital he needs to chase his dreams. Or your parents, now in their late 80s, need memory care, and you sell a piece of real estate to cover their nursing home bills. You do these things because you are a good person. You do these things out of pure, unselfish love. You willingly sacrifice your own accumulated wealth to lift up the people you cherish. And how does the system reward your generosity? The system records the withdrawal. The system registers the massive spike in your income. And 2 years later, the system crushes you with Medicare surcharges. You took money out to help your children, and as a direct result, your personal healthcare costs become so overwhelmingly expensive that you risk becoming a financial burden to the exact same children you were trying to help. Your act of love is mathematically twisted into a financial crisis. That is the true, sick reality of this tax code. It punishes generosity. It punishes transition. It punishes people who simply do not know that they are operating under a microscope. This is not just a financial issue. It is a moral issue. The institutions rely on the fact that we do not talk about money. They rely on our silence, our embarrassment, and our assumption that the system is functioning correctly. They extract billions of dollars from hardworking retirees simply because those retirees do not know about the 2-year look-back, and they certainly do not know about Form SSA 44. You now possess this knowledge. You now understand the invisible architecture of the trap. But having this knowledge is not enough if it stops with you. Right now, as you listen to this, you have friends who are in their early 60s. You have older siblings who are planning their retirement parties. You have colleagues who are talking about selling their homes to downsize next year. They are walking completely blindfolded into a buzzsaw. They are planning acts of generosity, they are planning massive financial restructurings, and they have absolutely no idea that they are about to trigger a permanent, devastating penalty on their future health care. They trust the system, and the system is quietly waiting to harvest their wealth. Do not let them become a statistic. Do not let the government siphon their fixed income because of a completely avoidable technicality. You have a moral obligation to pull the blindfold off the people you care about. Take the link to this video and send it directly to them. Send it to your parents, your aunts, your uncles, your coworkers. Tell them they need to sit down in a quiet room and understand exactly what happens at age 63 before they make a single financial move. You are not just sharing a piece of financial trivia. You are actively intervening to protect their life savings. You are handing them the shield and the map to navigate a minefield they do not even know exists. We cannot rely on the institutions to protect us. The system will never volunteer to take less of your money. We have to protect each other. We have to share the rule book. Stay vigilant, protect your family, and never let them take $1 more than they deserve.